Saurabh Mukherjea of Ambit Capital joins us now. Saurabh, good morning. Thank you for joining us. Saurabh, enough and more has been discussed about banks. What is your fundamental view? Do you think there is too much of noise, or the concerns which are now being flagged around leadership issues in private banks is real, and this is going to haunt some of these private banks for a long, long time?
I mean, look, there's two different sets of issues here. One is that lending to corporates in India has never been a profitable activity. It wasn't 20 years ago, it wasn't 10 years ago, it isn't now. And whether private sector banks do it or public sector banks do it, it would appear nobody really can make money from lending to corporates. So that's a big structural issue. If we're really going to move forward as a country, we need to figure out whether the bankruptcy regime can deliver justice for creditors. Lending money to large corporates and not getting it back is not, it can't be the basis for building a large free market economy. So I think a lot hinges on the bankruptcy court. Can it give creditors a better regime via which they can get money back? The NPA issues that we are still contending with obviously are 4 or 5 years old. I don't think we have maxed out on the NPA issues. I think NPAs will keep rising through most of FY19. So, but the core issue on can corporate credit quality improve? I think the answer to that lies in the bankruptcy regime. A slightly separate point is what can actually shareholders do with regards to corporate governance, whether it's in these banks, whether it's in other Indian companies. I think we've reached one of those junctures in the evolution of this country, where I think some very difficult questions will be asked by the public of large institutional investors as to what are they doing if they're not holding companies responsible for the way companies are managed, the way they are governed. If it's a promoter-owned company, it's a one thing, but in these banks, these are large institutions owned by institutional investors, and it's not evident that institutional investors have been proactive in bringing about changes in the quality of management. And I think that some very difficult questions will be posed to institutional investors in the coming year with regards to their role in all of this.
So, Saurabh, are you making a case that even though corporate banks have corrected, the price to book, maybe in case of ICICI Bank and Axis Bank, is sub 2 times, you will not be in a hurry to buy them?
I think whether it's those two banks you mentioned, or indeed the public sector banks with exposure to corporate credits, I'm not sure the time has come to load up on banks with heavy corporate loan books. Whether they're public or private sector, I think is secondary.
Saurabh, hi, morning. Have to discuss crude. Now that crude is already at 70, Saudi Arabia is talking about levels as high as 80. Which they would predictably, any producer would. It's in their benefit, and especially because of Aramco's large IPO also in the pipeline. But what could it really mean for us? And would you say that really challenges RBI's rate stance? Because in the policy as well, as dovish it may be, there were those caveats which strongly read that all the assumptions are based on crude sticking by below the 70 mark. If it nudges back to 70, then of course, it all completely changes.
Look, I think crude is a familiar villain for the Indian stock market. This is one item which imposes pressure on our fisc. So I think it's reasonably clear that given that we're in an election year, if crude continues rising, the government will have to continue taking a hit on its tax collections in order to buffer to some extent the petrol pump price of oil. So crude has obvious bearing on our fiscal deficit, and adverse bearing on our fiscal deficit, and hence on bond deals and interest rates in our country. And the other way in which crude comes into play is it does have a bearing on inflation. While the direct hit on CPI is modest, I think it's only 4-5% direct flow from crude into CPI. Indirectly, through the price of manufactured goods, crude has a bearing of around 10% on our CPI. So it's a familiar villain for the Indian market. I think 70 and above will be uncomfortable territory for us. There's very little we can do other than watch how it plays out. But I did find the RBI's recent policy, unusually dovish. I was sort of a little taken aback as to where, out of the blue, our central bank managed to find such a benign inflation outlook given the crude points you raised and given what the government has been repeatedly saying about juicing up MSPs in an election year.
Other hope in the market, Saurabh, now that we are going to officially kickstart earnings with Infi coming out with its numbers on Friday, would you say that an earnings revival is imminent, or is there still a case that we may continue to be staring at a muted earnings performance? Because some of the brokerages this morning have highlighted, they're saying, you know, earnings revival is still a long time in the coming.
So I think the main bright story that we've been discussing on your channel is the fact that there is clearly an economic recovery underway. You can see it in the cement demand data. You can even see it in the credit offtake data, in spite of all the craziness that's taking place in bank boardrooms in our country. You can see it in obviously auto demand data. So there's clearly an economic recovery underway, I think underpinned by the GST rollbacks of October, November, and hopefully further stimulated by the government's desire to throw money at rural India in the next fiscal. That I think is the brighter story, and my view remains that on the back of this economic revival, FY19 will be the first year of double-digit earnings growth after 5 years of 4, 5, 6% earnings growth. So I don't think Q4 itself will offer that much succor for those looking for EPS growth revival. But I think FY19 should be a year in which the economy juices up, courtesy the government stimulus to rural India and courtesy the GST rollbacks. I think we were all hoping for a PSU bank recap, but I think given all the events that have taken place in the jewellery sector, I think a PSU bank recap might not be that forthcoming in the next few months.
A large part of the earnings revival story was also linked to the capex revival, and you're saying that that's likely to suffer because even before investment demand and the investment cycle and investment appetite can pick up, rate rise might be a reality. Inflation might lead to the cost of capital going up.
I agree with you that the capex cycle looks unlikely to revive in FY19. I think the capex cycle reviving before the elections looks highly unlikely for a number of reasons. But I think two areas where one should be relatively optimistic is firstly the domestic consumption picture and the overall domestic demand picture from a consumer perspective, where courtesy low interest rates, courtesy the NBFCs being happy to lend from everything from mobile phones through to buying a mortgage, and courtesy the GST rollback, the domestic consumption picture I think looks in better shape than it's done in the last 4 years. And the second piece is the global demand picture for our IT services companies, for our metals and mining companies who implicitly plays on the global commodity market. I think the outlook is brighter now than it has been for some time. And these two pieces are around 2/3 or nearly 70-75% of the Indian earnings piece, the domestic consumption piece in the broader sense of the word, and the global demand piece. And I think with these two in reasonably robust shape, I think we're in a good place to have a earnings revival in FY19. I'm not expecting 19-20% earnings growth. My expectation is around 15% EPS growth in FY19, which is a lot better than what we have seen for the last 5 years.
Where will the growth revival story pick up from? We've seen the problem with the banks. We've seen what pharma is doing. That sector is not out of the mess just as yet, or at least you won't call it a mess. I think that's a story solely to do with banks. But pharma's had its challenges. IT, I think Infi guidance would be telling about the potential revival there and business picking up, especially linked to the United States recovery story. Cap goods, I'm thinking construction. I don't know where the definitive growth potential would play out.
Right. So I guess if we knew all the answers, we would be discounting it fully in share prices. I think the three areas where we've got reasonably good visibility would be firstly the domestic picture, especially around rural India. I think the government's been very clear since the union budget. The government's been very clear about how much they want to spend on the rural piece. So if you look at the budgeted numbers itself, just on food subsidies alone, the government's subsidy spends are up good 20-25% YOY just on the budgeted figures alone. And I think this being an election year, there's a good chance that the subsidy outgo for rural India will be significantly higher than the budgeted amount. So you're looking at anywhere between 20 to 30% jump in the government outgo on rural areas generally, on subsidy spends specifically. That should be enough to give sectors like tractors, FMCG, two-wheelers a nice stimulus in an election year. If monsoons play their sort of normal role, we should have a decent outing there for the entire piece linked to rural. The second area remains the entire auto pack. We've had a very good FY18 for auto, especially. I think trucks seem to be in good shape. And provided our interest rates don't fly through the roof, I don't see any reason for the RBI to hike more than 50 bips. My expectation is FY19, the RBI hikes by 50 bips. I think the auto sector will continue to remain in fine fettle. The truck sector seems to be showing some acceleration in demand, which correlates nicely with cement demand picking up very nicely in the last 6, 7, 8 months. And I think the third piece, which is the most unpredictable piece, is, as you were mentioning, the global piece. Whether it's the IT companies, whether it's metal prices, our metals and mining companies are heavily linked to global metal prices. Which way they do it, which way those prices go is hard to say. But given all the signs we're getting of a concerted global revival, it would appear that metal prices should have an upward bias in FY19. And there's nearly, I think, a 70 or 80% correlation between global metal prices and the earnings of our metals and mining companies.
Right. Saurabh, so net, what is it that we're staring at? Considering, all of February and March, we've seen that fall of about 9 to 10% from the January highs. Largely, the devils, as you rightly put it, are all known devils that we're dealing with right now, unless, of course, Trump throws another dart from the dark. Would you say that the worst is behind us, or is there case that the market could retest perhaps new lows yet again?
Yeah, I mean, as you might remember, I was very bearish through the winter. In January, I could scarcely believe what was happening in terms of share prices. So my reckoning is we are halfway through a much required correction. I think the market's still around 10% overvalued, and if for whatever reason, either because of political reasons or because of the scares in the banking sector, or because of brokers pulling back unusually optimistic earnings estimates for FY19, which is par for the course for most brokerages. For whatever reason, I think if we can pull back another 10%, I think then we are left with a fairly valued market. We're still a little too rich. I think we're 10% too rich at the overall market level in valuations. I think the BFSI sector in particular still looks to be overvalued by a good 20-30%. So if the market pulls back another 10%, BFSI pulls back 20-30%, I think then we are in good shape to tell our clients to go and buy the market as a whole. But for now, the focus still is very selective. This focus is on high quality companies where we have faith in fundamentals, faith in the management teams and corporate governance. We're not yet at a stage where we tell our clients that go out there and party. There's a bull market underway. I think we'll wait for valuations to come up another 10% before we give the green signal for all out buying.
So Saurabh, let's break the market into 2 or 3 large parts. One could be classic consumers, which are very expensive. Then you got the global dominated sectors, whether it is IT, pharma, maybe energy and metals to some extent. And then you got the pure cyclicals, the capex, the cement companies, or companies which will benefit if economic recovery moves higher. Which end of the market do you think has the best proposition to offer? It could be 10% lower, it could be 5% lower, it could be 15% lower. That frankly, no one knows that what could be the short-term correction. But where would you say that I'm going to be a buyer in these fall? These are 3 legs and I will associate myself with these 3 legs.
I think 6 months ago, 3 months ago, I think I was screaming myself hoarse on every media outlet which would air my views that Indian IT was significantly undervalued. I think some of that undervaluation has closed in the last 6 months, 3 months, but I still believe that our frontline IT stocks offer very good value. These are reasonably well-run companies. I know some of them have got plenty of cash and they don't quite know what to do with the cash. But that apart, in the context of demanding global consumers. These are well-run companies, and I still believe there is value to be had in one or two of the frontline IT stocks. I think the second area where it's difficult to see how these companies will not make money is metals and mining. Both in ferrous and in non-ferrous, we've created basically oligopolistic constructs where one or two players dominate our ferrous and our non-ferrous metals and mining sectors. And I can't see new capacity coming on stream for 3-4 more years. Where will you get the land? Where will you get the coal? It's all pretty much impossible to add capacity in ferrous and non-ferrous. And therefore, if global prices rise and the Indian economy slowly recovers over the next 3-4 years, I think dominant players in ferrous and non-ferrous will be in good shape. So I think that's the second area to consider. I don't think metals and mining companies are overvalued at this juncture. Yes, they have got capital allocation issues, they have governance issues, but you'll have to hold your nose here and buy one ferrous and one non-ferrous company in order to benefit from that rally. And the last area, as we were mentioning, discussing before, is rural. If the government airdrops the best part of 20-25% jump in spending on rural areas in an election year, as all the indications are that they will, then tractor plays, FMCG plays, two-wheeler plays should see a sharp jump in volume growth in FY19 vis-a-vis FY18, and valuations for some of these companies, some of them are large cap, some of them mid cap, are still quite reasonable, I would say.